Two guys, same age, same salary, same goal. One picks a 401k, the other picks a Roth IRA. They both invest for 30 years and retire on the same day. So which one actually ends up with more money to spend? The answer will completely change how you think about retirement, and we are running the full numbers right now. Meet Daniel and Ryan. Both are 30 years old, both earn $75,000 a year, same city, same tax situation, same dream of never working again someday. The only variable is where they park their retirement money. Daniel goes with his employer's 401k. His company matches 4% of his salary, which is $3,000 of free money every year. Daniel contributes 10% of his own pay, so $10,500 flows into his account annually, all before taxes touch it. His paycheck barely flinches. Ryan opens a Roth IRA and maxes it out at $7,500 per year. No employer match, no upfront tax break. Every dollar he puts in has already been taxed. His paycheck feels noticeably lighter than Daniel's from month one. On the surface, Daniel looks like the obvious winner. But here is where things get genuinely interesting. For the first several years, the scoreboard heavily favors Daniel. His 401k contributions lower his taxable income by $7,500 annually, saving him roughly $1,650 in federal taxes every single year. Real money back in his pocket right now, not some distant hypothetical. Add the employer match, and by year 5, Daniel's account has climbed to around $64,000. Ryan's Roth IRA sits at about $46,000 during the same period. Every metric says Daniel is crushing it. But what Daniel cannot see yet is that there is an invisible passenger riding along in every dollar of that 401k balance, and that passenger is the IRS. The tax bill does not disappear with a 401k. It just gets mailed to a future version of you, and that letter has some genuinely shocking numbers inside. Here is what that deferred tax envelope actually contains when Daniel finally opens it. Every withdrawal from a 401k gets treated as ordinary income, the same as a paycheck. If Daniel pulls $60,000 per year in retirement, the government taxes it at ordinary income rates. After the standard deduction, his federal bill runs about $5,100 annually. Over a 25-year retirement, that adds up to roughly $127,000 in taxes on money he thought belonged entirely to him. Then there is the required minimum distribution trap. Once Daniel hits age 73, the IRS mandates he start withdrawing whether he wants to or not. If his balance has grown to around $2.6 million by that point, his first forced withdrawal could be close to $98,000 taxable dollars. And those 401k withdrawals can push Social Security income into taxable territory too, potentially hitting 85% of his benefits with taxes. Ryan pulls $60,000 from his Roth and pays exactly zero in federal taxes. Now, before you crown Ryan the winner, the Roth has real limitations most people conveniently ignore. The Roth IRA contribution limit is painfully low compared to the 401k. In 2026, Ryan caps out at $7,500 annually. Daniel can shelter $24,500, more than 3 times as much. That gap in contribution room compounds dramatically over decades. There is also no employer match on a Roth IRA, and that matters enormously. Daniel's employer contributes $96,000 in matching funds over 32 years. With compound growth at 7% annually, that match alone balloons to roughly $354,000. Ryan has to generate every single retirement dollar himself with zero free money ever entering his account. And if Ryan's career takes off and his income climbs past $168,000 as a single filer, the Roth IRA door closes on him entirely without backdoor strategies that most people find complicated and never bother executing. The upfront tax savings Daniel captures represent real money too. So neither account is the villain here. What actually happens when we run this all the way to retirement day is genuinely surprising. After 32 years, Daniel retires with approximately $1,238,000 in his 401k. Ryan has around $885,000 in his Roth. Daniel looks like the clear winner by over $350,000. But apply a 22% tax rate to Daniel's balance, and his real after-tax wealth drops to roughly $966,000. Ryan keeps every single penny of his $885,000. The actual gap shrinks dramatically, and almost all of it traces back to the employer match. Remove the match entirely, and these two accounts perform nearly identically after accounting for taxes. There is one more scenario that reveals something most people never consider about the Roth. Imagine both guys need $30,000 at age 50 for an emergency. Daniel withdraws from his 401k, pays a 10% early withdrawal penalty plus income tax, and walks away with only about $20,400. He needed $30,000 and received 2/3 of it. Ryan withdraws $30,000 of his contributed principal from the Roth, which is always accessible penalty-free and tax-free at any age. He keeps every dollar. Same emergency, $9,600 different outcome. So what is the actual winning strategy here? The answer most certified financial planners consistently recommend is not choosing one over the other. It is sequencing them intelligently. First, contribute to your 401k up to the full employer match percentage. That match represents an instant 100% return before market growth even enters the picture. Walking away from it is the most expensive financial mistake most working Americans make. Second, once you have captured the free money, max out a Roth IRA. Lock in today's tax rate on $7,500 and let it grow completely untouchable by the government forever. Third, if you still have investment capacity remaining, return to the 401k and push contributions higher toward the annual limit. Match first, Roth second, 401k third. That sequence captures the employer's free money, secures tax-free growth, and maximizes your total contribution ceiling all at once. The real danger was never picking the wrong account. The real danger is picking one based on a coworker's opinion or a 30-second social media clip without running the numbers against your actual salary, your actual tax bracket, and your actual retirement timeline. Because the account that wins for someone else may absolutely cost you. And if you are curious how both of these stack up against a regular taxable brokerage account with no contribution limits and no withdrawal restrictions whatsoever, that comparison might genuinely be the most surprising calculation of all.